All right. Well, if you're with me today, thanks for joining. We're going to continue our talk on Elliott waves. Frank gave a great talk on Elliott waves last week and introduced a lot of the key concepts. And today we're going to continue that. Elliott wave is a very deep study, discipline, approach to looking at charts, and you can spend years studying Elliott wave. We're just giving a very brief overview overall to the approach and giving you guys just kind of some of the fundamentals, giving you guys a basis to continue your studies, and Eagle may in the future even have a dedicated Elliott wave class. So first of all, I'm going to introduce myself. There we go. My name is Peter, and I'm a trader, and I also work on the algorithmic side of designing algorithms that approach the market, scanning, just decisions in trading, and some of the infrastructure as well. And I enjoy and love the thrill of dealing with the markets that are challenging and always giving you new problems to solve. And so tonight, our roadmap will be that we're first going to review the rules of Elliott wave and kind of brush up on that. And then we're going to introduce the channeling technique, Elliott wave channeling technique. We're going to practice this technique with some real world examples. And then we're going to go into further depth about corrective waves, as well as wrap up with some Q&A. So we're going to go about an hour and a half today, just because this is a lot of material we're covering. So yeah. All right. So first of all, review. First of all, if you remember correctly, there are two types of waves. There are motive waves and there are corrective waves. Take a second to look at this wave pattern and just see if you can kind of see some particular patterns to these type of waves that make them different, the motive wave and the corrective wave. Just take a second to do that. Okay, so I know it's a lot of data up here and I just don't want it to be overwhelming. So yeah, but it does have a pattern to it. Motive waves or impulse waves are waves that follow the pattern of having 5 waves or parts to it. So there's first an impulse wave, then there's a corrective wave, impulse wave, corrective, impulse. So the impulse waves, there's a fractal component to Elliott wave, in which an impulse wave is made of impulse waves. So the same pattern that makes up the larger also makes up the smaller. And this is a concept we see in nature as well. Like a great example of this is like snowflakes. Snowflakes are pretty much 100% fractal in nature, like these small little things that make the larger is made of smaller things that are basically the same. You can see this in crystal structures. And so, yeah, these concepts such as fractals and Fibonacci sequences, these are recurring patterns that we see in nature all the time. So, an important note about Elliott wave is that Elliott wave is more built on observation. It's not a law. Elliott wave is not a law of nature per se. Like Newton's laws, or some of our like fundamental physics laws. It's really more of a pattern that the founder and practitioners who have followed have actually seen these patterns continuing and yeah, sort of codified the rules based on those observations. And so just keep in mind that in the wild, that big trading organizations, people with large amounts of money, retail traders, they're not all like following these rules, like obeying them, like, you know, first of all, it's, yeah, well, obviously you know that nobody's like just following the rule because they have to or something. But even more than that, it's more a description. It's more of a sort of quantitative description of what happens at a large scale with psychology of mass of people. The general idea behind Elliott wave is that in order for progress to happen, so to go from A to B, and markets generally do go up, there's a lot of reasons for that, and that, you know, has to do with like economics, economies. The government obviously creates sort of economic situations that propel the markets forward. And so, yeah, they create these patterns of movement upward. And so if you think about it from a very basic logic standpoint, if you want to continue going up, you need to move up more than you move down, every subset of movement. And so in this way, impulse waves cover more ground than corrective waves in a larger scale. But then you have to think about this impulse wave from 4 to 5, the fifth wave, obviously covered about less ground than this bigger, higher level corrective wave. So it's about levels, and so there's all sorts of like the nomenclature for writing Elliott waves includes this, would you say, just level concept, like, and so there's actually technically a technical rule for how you denote a large scale wave versus a small scale wave, and it has to do with this, with like these parentheses, these Roman case letters, and so, yeah, well, Roman case numbering system, that is. And so, yeah, if you practice Elliott wave long enough, you'll start to recognize the difference between this being a smaller wave set and then this 1, 2, 3, 4, 5 being a larger wave set. It tends to rotate between the Roman numerals and the just regular digits for like, that's an easy way to see that this pattern is at a higher level than this pattern. For me, I personally I'm not like a stickler on it, like, oh, it has, like, this is what the definition of what a subminuet is, you know, and this is like a primary wave set, you know, like there's technically rules for that. I didn't include them in this because I just don't think that it's that important, but just know that there is a sort of a hierarchy. And so if you follow practitioners, you'll start to see them denoting these, you know, and probably, you know, people that make it their profession probably do tend to care more about those levels. But just as somebody who's early on, I wouldn't worry about it much, and it's not a big deal. It's really just for the purpose of communicating from one person to the next, how high of a level. So remember, we talked about fractals. This is like a large scale movement, and then this is a small scale movement. But because they're fractal in nature, this is an impulse, and then this is an impulse. This is an impulse that makes up this larger scale impulse. So anyway, if I haven't confused you yet, let's go over the rules for an impulsive wave. The first rule is that there are always 5 waves in an impulse. The second rule is that wave 1, 3, and 5 are always impulsive, while wave 2 and 4 are always corrective. So this is wave 2, This is wave 4, corrective in nature. And corrective waves, we're going to go over those in further depth later in the session and talk more about them. They're an area that you can spend a lot of time studying because corrective waves are very messy. They don't behave as uniformly as impulse waves, and yeah, like that's kind of where some of the challenge and skill comes in terms of Elliott wave trading. Wave 3, the next rule is that wave 3 cannot be the shortest of the 3 impulse waves. So that means that you could have wave 1 be the longest, you could have wave 5 be the longest, you can have wave 3 be the longest, and most often wave 3 is the longest. That's kind of the nature, the psychological nature of wave 3. And Frank did a great job in the last session of just talking about the psychology behind each of the waves, which is really an amazing concept. And I'd really encourage you to rewatch that and look over that. So I won't redo that now. But yeah, wave 3 tends to be the largest because it's just when the largest amount of people are recognizing the movement up in the stock or whatever you're trading. But the rule is that wave 3 cannot be the shortest because it fundamentally disobeys the concept of wave 3, which is that it's the part where everybody catches on to the fact that this thing is moving up. Wave 4 will not overlap the price territory of wave 1. So if you see where wave 1 ended here, wave 4 should not come into that territory. You're probably dealing with a corrective wave at that point. And this is what Elliott wave is a lot about. Whenever you have this sort of structural system, in which a lot of trading systems are structural systems that assume some sort of way of looking at the market from a structural standpoint. That could be Wyckoff, that could be Elliott wave. You've also got the basic sort of things like cup and handle or head and shoulders. Like those are sort of pattern trading, like very basic pattern trading. It's not really discipline per se. It just kind of has like these pattern statistics and yeah. So whenever you're doing one of those kind of disciplines, you're going to have basically the system of like discerning when something is the pattern that you're thinking it is and when does it prove you that it's not that pattern. And so that's a big part of the skill of Elliott wave, is keeping these rules in mind and recognizing when, wow, like wave 4 corrected all the way down below wave 1. Maybe my entire count was wrong. Maybe instead of this being the beginning of a 5-wave move, and we're in wave 4 and we still got upside, maybe in fact this was only a 3-wave move. It was a corrective move up. And in fact, we're seeing an impulse wave down or something. Those are the kind of thoughts and things that you're going to run into as you practice Elliott wave. You're going to be just kind of looking at multiple possibilities. You're going to be entertaining just different scenarios. And it can drive you crazy, honestly, at times, like where you're like, and you're going to run into this point in the beginning of Elliott wave when you're studying it. You're like, oh yeah, everything makes sense. Like it's an impulse wave, and you see impulse waves everywhere. They say that if you have a belief that like you start looking for quarters, you're going to find quarters everywhere. They're going to be in your couch. They're going to be like on the ground. You're just going to see quarters everywhere. Why? Because you're filtering your reality to find quarters. And in the same way, for Elliott wave, when you first start doing it, you go through this euphoric phase where you're like, yes, like I see impulse waves everywhere. Like, man, I'm going to make so much money. I'm just trading these impulse waves. I'm recognizing these corrective waves. You start looking back at history and seeing like all these patterns, and it's great. But this is kind of in general, if you've been trading long enough, you've seen this cycle happen in every discipline, where it's so obvious in hindsight. But then when you get the whole thing is when you get in in the action and you get your own psychology mixed with the chart and the uncertainty and the voice of other people that have opinions, and you're hearing those opinions, and maybe you're following some Elliott wave trader and you're listening to what they have to say about the market. You know, they're out there, you know, they do on YouTube, like, hey, here's the Elliott wave count for the current market that we're in. And, you know, we're going all the way down back to the COVID low. You know, like there's some people in the Elliott wave community that are calling for that. And I'm not trying to say they're right or wrong. I'm just trying to say that like they have an opinion about where we're going. And you can start to develop that as an Elliott wave trader, where you start to think that you see really far into the future. And that can be, I think, personally, I think that can be dangerous territory, where you start to think that you know where price is going to go in the next half year, or the next year. Like that's, you know, I mean, there's so many things that are going to happen between now and that time, and you just don't, you know, you don't want to get biased, and that's the danger of having any sort of like discipline, like Elliott wave, Wyckoff, any you know, sort of like special technique, is that you can be a little too dogmatic about it. So that I'm just trying to warn you ahead of time that Elliott wave is not a magic bullet. If it was, every trading organization would be using it. And then if every trading organization was using it, then it really wouldn't be so powerful anymore, because you would just say, hey, like everything happens so fast. Like as soon as a wave 3 happens, it's up already, you know, like yeah, if there's an advantage to be found that's easy, then it's probably already been capitalized. Speaking from as somebody who has worked with and for large organizations that have an intense amount of money and can find the smartest of the smart people out there to crunch algorithms and mathematical ideas, and have just the most sophisticated technology to do it. It just, let me reassure you that there is not a magic bullet that's going to just make you money hand over fist easily in the market. It's a lot of work, and that, you know, that might be the bad news, but it's also the good news that, you know, if you're disciplined and you work hard at it, you can be profitable and like see better gains than you would if you were to just kind of go the same route that most people do in the market. And so, yeah, I'm not trying to discourage these techniques, but I'm just trying to say, don't become a sort of cult of Elliott wave, of Wyckoff, of whatever your persuasion is, and always be fluid. So I spent a lot more time on that than I had intended, but trust me, if you can take that message with any technique that you're learning, it'll save you a lot of time, a lot of frustration, being even disappointed in the technique. There's gonna be times where you're like, man, like that just seemed like such a perfect Elliott wave, impulse wave, and I was trading it just according to the plan, and then it just didn't work out, and I lost money in that trade, and you're gonna feel so disillusioned. And that we just need to remember in that time is that Elliott wave, like the markets do not obey Elliott wave. Elliott wave is just a general description of how the markets generally work, but like there are so many exceptions in times that it doesn't work exactly like that. And it's as simple as somebody who's very rich just pushing a button and saying, hey, like, you know, I'm just too nervous about the economy. Who knows, whatever they're looking at. And they're just like, yeah, like, you know, like I just don't like what the Fed's doing, and now I'm gonna take my money out. And then yeah, your 5-wave impulse all of a sudden now becomes a double tops out, and you know, never completes a good 5, you know, and you know, it just one person can make a decision. One person moving a lot of money can make a decision. And yeah, generally in Elliott wave though, what we're looking for is waves that seem to fit this pattern very well. It's sort of like, I've heard it called like the guideline of like visibility, or like yeah, just that basically when you look at the wave, if it's like generally following this pattern, then it's something of interest. But if it starts to get really funky, if you start to look at a chart that's really funky and just kind of moving around in crazy ways, like on a high time frame, then you just kind of want to stay away from it. like you don't want to try to predict every single chart. You want to more just get good at like scanning charts and saying, "Ooh, that's a good setup. I like that one." We're going to dig deeper into what that chart, what trades we can make in that chart. You get good at just finding where there's higher probability setups. We're not giving certainty, we're giving probability. So I've harped on that enough, and I hope that you're already at that part in your trading journey where you understand that trading is not about certainty, it's about probability. But with Elliott Wave, I just feel like it's incredibly important to emphasize that, because it can become very easy when we start talking about rules and patterns to start to think more in terms of absolutes rather than in probabilities. So next slide. Okay, let me see if there's any questions. By the way, okay. Oh, wow. I'm so sorry. I was muted on the Discord. Thanks to Sean and Javier for letting me know that. Oh my gosh. Sorry about that. Luckily, this is all recorded, and so everything that was said earlier, yeah, you can see on the recording from the Discord. So, yep, and it's just checked and it's being recorded. My bad about that, being muted on the Discord, Javier. All right, so let's talk first about an advanced Elliott wave technique known as channeling technique. So channeling technique, if you haven't already noticed, that price can follow channels pretty well, and channels can be very, very good predicting tools. And trend lines, channels, these things. So in Elliott wave, you can also have channels that help you find where the waves may go to. I'm not sure exactly who may have started this technique. It wasn't necessarily something that Elliot wrote himself. It's not like canonized so much, to my knowledge. And then if you're interested in further research, Elliot wrote a book himself on the technique, and there's so many books written, great books written about it. The person that I learned this technique from was Jeffrey Kennedy. He is a great Elliott wave trader. He's been doing it for so long, and he calls it the Kennedy technique. I'm not sure if he was the first one to create it or not, but yeah, he calls it the Kennedy channeling technique. I find that it works pretty well with Elliott wave, so I just call it the channeling technique there. And let's see. So if we talked about first wave, second, third, fourth, fifth, and let's see. So once we get our second wave completed, and we're starting to move into our third wave, we start to form a channel from the origination of the Elliott wave location to the second wave. This is the base part of the channel, and this is the top part of the channel. So I'm going to pull up TradingView and just demo this really quickly. So in TradingView, and Frank did a great job showing this earlier, but you have a Elliott wave marker here in the patterns section. Elliott impulse wave and Elliott wave corrective wave, as well as a sort of triple combo wave, triangle wave and corrective wave, and then double combo wave. Great, it's really great of TradingView to have done that. It's great. So yeah, you'll use this a lot if you're charting Elliott wave. So yeah, and you kind of have to finish the sequence in order to, you know. But what I like to do is, let me show you a few things. If you double click on it, you can choose whether to connect the lines or not, because that can get annoying a little bit when like it's intersecting with price and you're just like, you know, you want to see what the candles are doing. So you can turn that on or off. And remember when I talked about the degree, it's called the degree. You can change the degree on here to be like a very high level wave. This might be like years of price action, super millennium that is, to like primary, which might be, you know, like monthly level or something. And then to like small levels, like, you know, like hour, minute, you know, down to minuet. Technically, I think there's some rules like or guidelines or, you know, like, hey, like this is probably a good way to approach it. But I just find it like whatever helps you distinguish the time frames effectively is the important thing. And if you're communicating it to other people, they need to understand it too. So if you become like a professional Elliott wave trader that's giving talks at Vegas, you know, I haven't given a talk at Elliott wave in Vegas, but I have given a talk on trading in the stock market in Vegas. And you know, you need to make sure you know your stuff. The organization that, you know, I was speaking for, like really we had to sit down a lot and make sure that every last little thing I was saying is correct, because, you know, like you just have traders that have been there for years and years, and, you know, like it's important to get stuff right. So anyway, if you're speaking in Vegas about Elliott wave, make sure that your degrees are you know, like are correct and everything. But for most of us, don't worry about it so much. So I'm going to keep this on so you can see. But the channeling technique, basically, so what did we say has already happened? We said that so far we haven't seen any of this happen yet. It's just been 1, 2, and then we start to move up. So it looks like the second wave, the corrective wave, is complete. So what we do is we take the start of the wave and we go to the bottom of the second wave. But then we put the top of the channel here. So it forms this nice little channel. And I have in TradingView, I have all sorts of templates. I have like a base channel template so that it's colors so that I can kind of distinguish, oh, that's a base channel. Now, here's the thing about the base channel that's going to be cool. It's going to give us some targets for where the fourth wave will land. So just kind of remember we talked about like that guideline of visibility, like meaning that like it's just kind of like an Elliott wave will generally look something like this. You know, like when you start dealing with, well, like this is not, remember rule number 1, this breaks, well, not number 1, but like one of the primary rules, wave 4 cannot go below wave 1. So like this is not an Elliott wave impulse. Like, so, but anyway, generally we're going to expect that wave 4 is like, this is going to be one of our targets for wave 4. And then, I mean, it depends on the wave too. Like if this thing really extends a lot, like wham out here, like we could end up being in a place where wave 4 could end in the on the center line. Could be a center line reversal off of this channel. Can't tell you how many times you see a channel that like, you know, like this base channel was formed so long ago and then all of a sudden it comes into effect like months later. It's pretty amazing. And then a lot of times you see those things in hindsight. So we don't want to be in hindsight, we want to see it ahead of time. So so that's the base channel. Let's go back to our, well, I'll just stay in here. And then next we have what we call the third wave channel, or the acceleration channel. So let's say so we break out of this base channel, and that's like kind of our cue for like, okay, this is the third wave price action. Like this stuff is not just like bouncing around in this little channel and like kind of going through stereotypical price action that, you know, might follow a channel. Like this is like things are accelerating. And so what we do is we draw a line between 1 and 3 and the bottom of 2. And that is our base, that is our corrective channel. Let's see. Not corrective channel, I'm sorry, I was like thinking, well, next point, acceleration channel or third wave channel, essentially. So, yeah, this is just going to be the steepest channel in the entire thing. And we're probably going to see, it's going to also give us some potential targets as well with our fourth wave. So the confluence of these channels can give us some targets for where this point. So as we're in this channel, and an important thing to know is that as this is developing, like we're not really 100% sure where this acceleration channel is going to land. Like, see, it's going to be adjusting the entire time that this wave is moving up because, hey, it's here now on wave 3, but then if we keep going higher, eventually it, you know, lands here before it reverses. And then, you know, so my point is that you don't really know exactly where the acceleration channel is until wave 3 has finished. You might start to notice some interactions on this baseline. So for example, like if price action goes up and it's like this, and then it, you know, like it likes that midline of the channel, then that might be a clue that like this is like a possibility. So in Elliott wave, you're always dealing with future possibilities and you're drawing out multiple scenarios. I like to, in TradingView, put these scenarios in groups. Like you can do that. This is pretty cool in TradingView. You can create a group of drawings. So like, for example, demonstration. So this is like, yeah, and then you can like hide the entire group. So like as price action is moving up, you can create multiple theories for what's happening and say, hey, this is theory number 1, hide that theory. Theory number 2, make another theory. And then, you know, like that way you can be like pivoting really quickly based on the confirmation of that theory or the, you know, that doesn't work out. So anyway, so you find out that the acceleration channel is where it is when price action ultimately corrects from that third wave, and the fourth wave corrective price action starts to happen. Remember, the fourth wave is corrective, and so it's going to have like some sort of corrective price action structure. Now, triangles are, we're going to talk more about this, but triangles are a pattern that, according to Elliott wave rules, only happen in the second to last sequence of the entire series. And what that means is that for an impulse wave, the second to last wave is the fourth wave. So if it was a triangle pattern, it would be something like this, and it would always be in the fourth wave. So when you see a triangle, it's a pretty good clue that, hey, this is fourth wave here. Another thing about fourth wave price action is it tends to be a little weaker than the second wave. And this is just like psychologically because like before the sequence started, there probably came from some sort of like corrective price action and people are bearish. Then this price action happens and all the bears are thinking, aha, more correction. So like there's a lot of strength to the downside on the wave 2. But for the wave 4, everybody's gone already through three-wave price action where, you know, just everybody's making money hand over fist. And so like everybody's already thinking about the upside in wave 4. It's maybe a little bit stronger than most people expected. So it's like it caught a lot of, you know, people that were buying up here off guard for sure. But people are quickly starting to think about like, hey, well, hey, this wave 3 was amazing. Like, you know, I'm going to buy in. This is a good price. And so wave 4 tends to be a little weaker in terms of downside. It also, this is why the triangle tends to happen, because triangles patterns are continuation patterns. And then, you know, if you're looking here, this is a triangle, like you can draw out in TradingView. Wow, they've changed this thing. Did not used to be like this. Wait, is this an Elliott wave triangle? What sort of? No, this is not. Yeah, I thought not. There's something else. Yeah, that's the way that I'm used to it. I was like, what? TradingView totally changed the triangle. So yeah, there's an A, B, C, D, E for a triangle, and you can mark it out on this. We'll talk more about the triangle. Let me make sure I'm doing a cam time. Okay, go a little faster, but yeah, so second to last of the sequence. So if it's an impulse wave, that means it's the fourth wave. If it's a corrective wave, so for this downside, if it was like a corrective wave like this, the second to last is there's A, B, C. So that means it's the B wave. So that means that the triangle in a corrective sequence would always be the B wave. Now, here's the thing that, like, this is next level stuff here that I'm about to share. This is what most people never really learn or grasp, and this is what throws off a lot of people that are trading the fourth wave. So this is the challenge, is that people a lot of times will see triangles starting to form on the fourth wave, and they'll go, aha, fourth wave triangle. Like, I'm gonna buy down here. I'm gonna set my stop loss here. Like, I got this in the bag. Like, I just got myself a great entry to, you know, so somewhere around here, like, I just got myself a great entry to the fifth wave, like prime seating. What happens? Price action, because, you know, like, they're like, oh, a guaranteed win. Well, it goes like this. And they're like, what just happened? Like, the triangle broke to the downside on a fourth wave? No way. Like, they're just completely mystified. Now, remember, it won't go below the first wave territory, but I'm just doing this for illustration. Well, what really happened there? And, you know, like, this is, I'm kind of cutting ahead to the triangle part of the corrective wave part, but, you know, this is a good spot to talk about it. What really happened? Well, it wasn't really a triangle that was 100% of a triangle that was happening in this part. It was actually an ABC, which had a triangle in the middle. And sometimes that can look like a fourth wave triangle. So I don't know if that makes sense. Let me know in the chat if I'm just gonna let anybody in the chat. Let me know in the chat if that doesn't make any sense, because I can maybe explain it a little clearer if that is hard. I just might not have explained that well enough, but if it is understood, then I don't want to harp on it more. But that's revolutionary right there. And that, so you don't want to get stuck in that trap. Whenever you start to see a triangle form on a fourth wave, you need to keep in mind that it's possible that this A wave that you think is the A wave of the triangle is actually the A wave of a like a zigzag or an ABC wave, and that the triangle part that you're seeing is actually just the triangle of the B wave, and there's going to be another C wave to the downside. So you have to just keep that in mind. You have to keep that small structure in the triangle aware. You have to keep your stop losses, like, you know, like, you don't want to go below this triangle Now, I mean, we all know that like there's so many times that like there's a fake to the downside and then jets up. So you want to be aware of those swing failure patterns that can happen in any pattern basically, and like be able to react quickly to price action. Because like I said, trading is the Wild West, and these trading algorithms are searching for liquidity, and people's stops are put in predictable places, and so they know where to hunt them. And yeah, but just be aware of that like you can get sucked into this idea that, oh, this is the fourth wave triangle, you know, I got this in the bag. Be aware that this can happen. But when it does happen, there are rules and concepts for price targets for the ABC that really can give us some cool insight of like, okay, well, we do know where this won't go below. It won't go below the first wave. You know, if it's truly an impulse, it won't go below the first wave. And then we also, the cool thing is we also have all of this, these channels that give us some targets. So this base channel here really starts to come into effect on the fourth wave, where you start to see like this is a really good target here on top of this base channel. And then if that base channel was really steep, you know, like if this isn't a very steep base channel, but if it was very steep, you might have to go to the mid channel line before you get a reversal. You know, and then you have all these price targets, Fibonacci price targets for the wave, the AB based on a corrective wave in general, which might be like, and I have all these Fibonacci extension tools that I've customized to give that. So like for me, I have like templates for, okay, this is a zigzag and I'm doing it off of wave B of A. And so this gives me like some targets there. Let's see. Oh, I'm sorry. Wait, that's wave C. Yeah, wave C. There we go. So these are some targets. Like, okay, lesser possible targets here. Most likely 1-to-1 slash like these three levels are like the very common fib targets for a wave C. So I might be thinking like looking at here and seeing if this, you know, in terms of like I'm projecting this onto like this area. So if we break below this triangle, we start to think 1-to-1, where is that? Oh, it's right on top of the base channel. Oh, that's a great target. Like you might even just enter a trade there just because it's such a good confluence of areas, and then just keep an eye on it when you enter. You know, put some limit orders in. That's what I'll do a lot of times, is put limit orders in like really rich areas. So the 1.236, 1.382 is another. Sometimes it'll go all the way to the 1.618. I have these like kind of like darker based on how likely they are. So like these are like, it's kind of a weak impulse wave. These targets here, these are more standard targets. Wave C tends to be like kind of a little bit more, a little rougher than wave A. But rarely up to this point, because then you start looking at like, maybe that's not a corrective wave, maybe that's an impulse. So this is kind of how you're like navigating these targets, these fib targets. And I'm pretty sure you can Google a lot of these targets, and I think that the internet has a decent amount of consensus on them. I've put a lot into the slides to illustrate, but yeah. So anyway, as wave 4 starts, you also want to form a channel for wave 4 corrective price action, because corrective price action tends to follow a channel. So I put fourth wave channel, like, and I have them as different colors just so that I can distinguish them easily when I'm looking at a chart. So you'll tend to follow a corrective price channel, and I can't tell you how many times I've made a lot of money just trading a corrective price channel. Everybody else is like not interested at that point. For me, I'm like, you know, just trading the channel, buying and selling, like buying the bottom, selling the top, buying the bottom. So I can't tell you how many reps you can get in a channel. And if you stretch that price action out, oh my gosh, it can make, like, if you stretched out like all of this, like that can be a lot of money. So yeah, never underestimate how well you can do with trading a channel. Let me get back to my presentation. So I just kind of walked through how we would form these channels in concept. So let's take an example. I remember this is an example that was being traded back in like 2012, 2013 time, and this was a an analyst, an Elliott Wave analyst, was looking at this. Well-known Elliott Wave analyst was looking at this and charting it out, and I remember tracking this development of this. So yeah, so this, like we said, we formed the base channel. Let's see. I'll do on time. Okay, good. So that time. So we formed the base channel off of the so price action's going up, and then we start to see what this analyst believes is an impulse wave down, and so so we formed the base channel. Like, okay, so we start to see a like pretty strong price action going down, and then we see an even stronger reaction to the downside happening off that second touch. So form of a base channel, 1, 2, and then yeah, potentially starting a third. Price action continues and it breaks the base channel, as you would expect from a third wave. And look at how price action is, kind of bounces here, and it really doesn't want to go back into that base channel. It's like you'll see this a lot, the base channel acting as resistance or support, and then we kind of get a clean acceleration channel off of this low here. So you see it's like both of these channels are kind of working in confluence here. Be aware that when you have really skinny channels, like these are pretty skinny channels, honestly. Like this is a very skinny base channel. Like the price action can like move around a lot more and take more liberties with those channels than you might expect, just because they're so skinny, and like the volatility of the market might be greater than these channels can hold. So just be aware of that. Like when you've got a nice wide channel, then less so that. And in fact, it's more likely that price might not even make it to some of those parts of the channel. So price action continues to the downside. We see this acceleration channel that we formed right here really starting to work pretty well. We see a like sort of a channel climactic moment where price action breaks below the channel and then comes back in. That's a pretty good sign a lot of times that you're getting a different momentum at the opposite side. Starting to see some wicks here, like seeing buying and absorption happening on these lows, like initial absorption, test, more, like absorption. So like it's, yeah, something's to the upside at this point. Pretty strong move up at this point, unlike what you had seen before. You really hadn't seen any successful candles hold above. So it looks like we're forming a corrective price channel, forming a higher low on top of the acceleration channel. So, a red, or it doesn't have to be red, but it's our corrective channel, our fourth wave channel. And so just taking through how we're kind of forming these channels in live. And so, yeah, so at this point, price action continues to develop. It starts to actually kind of be a bit weaker than it can hold on that base channel. The base channel, the fourth wave channel. And so this might indicate to us that, okay, might be coming to an end. And look, we couldn't get back into that base channel. That base channel formed as support. I've chosen this example for a number of reasons. We'll reveal some of those reasons a bit later, but one of the reasons is that this is like a cool example because it's to the downside. It's an impulse wave to the downside. So remember, the fourth wave is corrective in nature, so we could be thinking that this is an ABC, in which C just kind of like stops short of you know, going even higher, and because maybe price is just particularly weak, and it also stopped right on the base channel. So then we could start our fifth wave down. And so you see here, we marked out the fourth, and price continues to go down to the fifth wave, and where it ends. So at this point, we see a big bounce. So this is the utilization of the channeling technique within this kind of like, okay, like finish kind of our impulse wave, right? And then we have to think about what's next. Well, what comes after an impulse wave? It's never another impulse wave. It's always a corrective wave. Yeah, it always rotates. Impulse wave, impulse wave, corrective wave. So at this point, we'd be expecting some sort of corrective wave, maybe. You know, now something to keep in mind is that generally the markets moved in an upward manner, and when you have impulse waves to the downside, you tend to more think of them as corrective, like an impulse wave within a small. I'm trading you here. You start to think of them more as, delete a lot of this. Okay. I'll just delete this way. There we go. All right, so when you get an impulse wave to the downside, a lot of times, because generally remember that markets tend to move up more than they move down, that tends to actually be more of an impulse within a corrective wave. So a lot of times, if you're getting this nice impulse move up, and then all of a sudden you get an impulse move down, you might think, you know, what that look like? That would look like, hey, things are going well, everything's great, fifth wave complete, bam, impulse wave down. And you're like, wait, what is that? Hold the phone. Like, it's supposed to be a corrective wave after an impulse wave, not an impulse wave after a corrective wave. Well, that's probably because this is a higher level impulse wave up. On the same level, there is a corrective wave down. You're right, a corrective wave is coming after this impulse wave up. Corrective waves, by the way, of the same level tend to correct to the level of the prior fourth wave. So in reality, that would be like this. I don't know if that makes sense. So like of the same level, there we go. So that means this, like impulse up, corrective down to the fourth. They tend to stop about at the fourth wave, the low of the previous fourth wave, the corrective wave. So so yeah, you're seeing an impulse up, and then you see an impulse down. Know that that's not all that's coming. You know, if the impulse to impulse, that means that this impulse is a part of the corrective wave, and we're going to get into this a little bit here today about corrective waves, the complexity of corrective waves, and this is where you can really get messed up if you don't understand your corrective waves. And in fact, this is actually what happened to this analyst. Is that they were thinking it's just an impulse wave down, but this analyst, I can't speak for everything that they were saying, but at the time, but it ended up being a bit more. It ended up going. Oh, it is going into extensions. I'm trying to find the slide. Okay, here we go. The wave that they were charting out ended up looking something like this, which technically fits the requirements. And I chose this example because it was a great example of how a very experienced Elliott wave analyst got the market action wrong. And this happens. Like, it doesn't matter how many years you've been doing it. You are thinking you're tracking an impulse wave, and it turns out to actually just be a corrective wave. And so what could, kind of doing this in the opposite order of what I had thought, but to do originally, but what could it have actually been like? You know, because it, like, look, basically this is what happened. The impulse wave that he thought was happening ended here, but when price action continued, it did one of these things. And you could say, oh, well, didn't it start another impulse wave to the upside? Well, that means that wave 2 went below wave 1, which is not possible. So what was this about? Like, that just, are you telling me this was like a crazy wave 4 of the 5th wave, that sub wave 4 of 5? Like, no way. It just doesn't look right. And this is kind of the guideline of visibility, is like, it needs to look right. And this looks more like an ABC wave. A, B, C. And so, yeah, this happens a lot. You know, you're thinking this, and what you'd be thinking after this, you'd be thinking, man, we got a little bit move up after this, and then we're gonna really get spanked on another impulse down. You know, like A, B, C. But it didn't work out that way. And so you got to be able to pivot. And I guess my point behind that is that it's easy to look at now, and I could just chart out some perfect examples, but I wanted you to see how even a very experienced analyst can get the concept wrong as price action continues to develop, and you got to be able to pivot off of that and say, oh, okay, like, that's why you got to make multiple theories, is like to be able to say, okay, oh, this actually could be like what I thought was a wave 3 actually is just A of ABC. And so we're going to talk about Fibonacci targets, and this will give like some further testing. And I actually developed an indicator that would actually like do a ton of fib tests on every single wave that you draw out, and it kind of like gives you a percentage of accuracy and stuff like that. So if you're somebody likes the code, you could make that up too. And maybe I'll release this indicator at some point. I just kind of threw it together for myself because I was just tired of doing all the math by hand. But let's see. Yeah, so fib targets. These are general patterns to follow, just like everything else we've said. But prioritize the market context. Like, what are the indices doing? What are support and resistances from high time frames? Look for confluence. Look for things that are all kind of coming together. Like, oh, this fib target. Sorry, my water here. Fib targets, support resistance, volume and spread analysis, all that kind of stuff. When you see things start to come together, that's when you're like, okay, this is a good target. So for the third wave, some price targets that we'll look at are, so for the second wave, you might be looking at like the 618, the 0.618, but also, like we said, it can go all the way to the bottom of, or the top, depending on where if you're going down or up, but it can return all the way to the start, potentially. The third wave, this is where we start to really get some targets from extensions, Fibonacci extensions, and I'm going to trust that you've already like learned extensions because we already have some modules on that, and yeah, I don't want to re-explain that. You can just look that up. So the extension is, it's an extension of the first wave starting from the second wave. And so our targets generally are the 1.618, the 2, the 2.72, and the 2.618. In this case, it went way below that. And so that might have been our first clue that this is not just a, you know, like, sure, it could be what we call an extended third wave. And there's all these kind of like little like ways that the rules could be bent a little bit. I mean, not all the rules, like some of them, like wave 2 cannot go below 1, wave 0 that is, and or location 0, and you know, fourth wave can't go below 1, that kind of stuff, that can't be bent. But like some of the things like the targets, they're a little looser. Like you could have what we call extended third waves. So we would just at this point think, oh, this could be an extended third wave, or maybe I'm completely wrong in my approach. So these are the kind of thoughts that are always going to go in your head. So yeah, and when you look back at the previous price action, you could see this area is like, okay, there's support right here, resistance, support, like support. This area seems like a reasonable area to bounce. I mean, you could also probably be looking at like this little area here. But yeah, so that's how like you use support as like support resistance levels as confluence. So the fourth wave, some levels that you'll look at for your fourth wave is you'll do a retracement of wave 1 through 3. And you'll want to see these, you know, these will be your targets, the 618, the 0.5, and the 0.5 was in the end the one that it came to. The 0.3, if it's particularly bullish or bearish, depending on if you're going down, if it's particularly bearish, it'll hit the 0.3. If it's bullish, it'll, yeah, I don't want to confuse you by flipping the direction there, but yeah, if it was a wave, impulse wave to the upside, like 318, 382 is more the bullish situation. You kind of use the context of like the stock to say, you know, like, you know, it feels pretty bearish in general. I'm expecting that it might only hit 382. I'll just stick to this example. So like, if it's really bearish, then it would hit 382. Particularly bullish, like on these things. So fifth wave targets, you might use the 1 through 3 Fibonacci. So 1 through 3 Fibonacci extension off of the top of wave 4. Give you these targets, 0.5 to 0.6. Now, if you use any of these targets, like the upper parts of these targets, you'd be in profit, even though it didn't exactly stop right at the target. So that's like, first of all, I know it might be easy to like say, oh, it didn't stop exactly there. Well, remember, these are like confluence of multiple things together is what we're looking for. So using the channels as well as the targets, you start to see like a little cluster. Now, you can get sometimes deceived by clusters where you're like, oh, it's such a perfect cluster. I'm just completely going to wait for price action to go there. That happened to me with Wix, like recently, not recently, like last year. I had such an amazing trade on Wix going, and I was in such good profits. And there was just like this perfect exit that I was looking for. And I was like, yeah, like, because it was the combination of the channel as well as the Fibonacci target, as well as support resistance. And I was like, it's going to the spot. And I think it like stopped just a couple of dollars short of my target. And I didn't exit. So I was so stubborn. I was just like, no, I'm going to let it threaten me, and then it's going to hit my target. I'm going to get my limit order out and everything. It never went. And I was so stubborn. I just stayed in it because I was so persistent on this idea. And it's like, I ended up like, I didn't even stop out at break even. I was like, no, I'm not about to get out now on a low point. And I had actually like lost a little bit of money on that trade. It was like the stupidest thing ever. So my point is like being hard-headed with your targets is not a good idea. Like, you know, they're approximations. But anyway, as we said, it was an ABC, or at least that seems to fit the situation better. And so this is what you're gonna kind of, this is what you're gonna run into a lot, is that you know, you create a theory and then price action might do something different and you need to be able to pivot. So it's not to say that, like, look, our trading plan of trading this like an impulse wave was making us money the entire time. We were tracking this wave really well. Now, remember, there were a couple points where things just didn't exactly hit just right. Like, you know, we fell out of this channel a little bit before we ultimately failed out of it. You know, the Fibonacci targets were a little off, but to the most part, like, our channeling and analysis work made us pretty good money throughout this entire, you know, as we were tracking this, you know, assuming you had good trade management, which is a big assumption. But yeah, if you had good trade management, your analysis of this as a impulse wave would have made you money. But in the end, it didn't even completely confirm in that way. So you need to be able to pivot quickly and say, okay, I see what's going on. Like, this isn't like, because this would have thrown you off. You're like, wait, you know, what's going on? Or maybe even just like stopping here would turn you off because you would have been thinking like, okay, ABC, no, yeah, impulse down, corrective up, impulse lower. And then you would have been thinking, wait, why does it just stop here? Well, because it was an ABC. So you need to be able to pivot quickly, and you would have had to have been entertaining this idea that maybe my idea that it was an impulse down, it actually was an ABC the entire time. So that's why you want to create multiple theories in the Elliott wave, and you want to stay flexible, because that's how you pivot quickly, and you're able to make money faster than the rest of the market because you're just you're fluid. So any questions on any of that before I move on? And this is like kind of a hindsight breakdown of this Coca-Cola situation back in 2012-13. In hindsight, this pattern seems to fit better, that it was an impulse down, corrective up, impulse down, impulse down, and then for the A wave, the B wave was a corrective up, the C wave was an impulse down, corrective up, impulse down. Seems to kind of fit the guideline of visibility here. So yeah, and like I said, like, this is an analyst that was, you know, very experienced, that I respect a lot, who, you know, made this assessment in a way that, like, didn't work out. And it just goes to show that, like, after years of doing it, you're still, like, you're running on a theory, and then that theory is disconfirmed, and you pivot quickly. That's how you become good at this kind of stuff. So amongst wave types, maybe so we have impulsive wave. Now we're going to talk a little bit about corrective waves before we close out the next 20 minutes. Oh, my pictures didn't go through. Why didn't my pictures go through? They were so, I like them. Really? I'm just like, maybe it's a full screen thing. Oh, okay. I think they got taken out because they were too extreme. It was just a bunch of crazy animals that were like looking ferocious here. And I was like, yeah, welcome to the jungle if you're in corrective wave world. I guess it didn't look professional enough. All right, fair enough. I just like, I'm previously was a professor in engineering, and I've just learned anything that can keep your attention and help you remember things is helpful. I mean, aside from anything vulgar, but like, yeah. So All right. So amongst corrective waves, we have a couple different types. We've got ABC waves, we've got flats, and we've got complex corrections and triangles. Now, we're going to look at, see if I have a, yeah. Well, these are pictures of each of them. So, like, because that doesn't mean anything to you if you just see ABC, flat, complex, triangle. So zigzag for an ABC, follow the form of A, B, C. There's two types. So a zigzag is like a 5, 3, 5. Now, what does that mean? That means 5 waves, 3 waves, then 5 waves. So when you see this format a lot in Elliott wave, where you say, oh, it's a 5, 3, 5 wave. Well, that means 5 impulse down, 3 up, 5 down. Or it could be an ABC where it's 3 down, 3 up, 3 down. So a 3, 3, 3, as we said here, an ABC 3, 3, 3. So corrective, corrective, corrective. Zigzag has impulses down. They're vicious. Zigzags are vicious to the downside. Like talk about how stocks take the stairs up and then they jump out the window onto the downside. You know, it's like this is that window jumping here of like impulse down, slow movement up, impulse down, and everybody thinks it's going to continue here, and then it just like reverses. Thanks, Javier. Yeah, I appreciate that. And this is just the gems and wisdom, knowledge that accumulated from other teachers over the years. And I'm just really glad to share that with you guys and, you know, kind of accumulate years and years of study into one class. And like I said earlier, like you can study Elliott Wave and read books and follow people charting it out for years, you know, and still be learning. So hopefully this class is just the beginning of a journey if this technique really aligns with you and connects with you. So a double zigzag, this is where you have, where we get, in a substructure, we get a corrective wave, and then another corrective wave inside of a big corrective wave. We start to call that a WXY. This gets confusing for people. A lot of times they're like, wait a second, what is a WXY? Like, what's the difference between an ABC and a WXY? Well, I'm so confused. Well, you know, it's two zigzags. So remember we said the zigzag is this 5, 3, 5, 5, 3, 5, one zigzag, A, B, C, 5, 3, 5. So these are painful. These are painful corrections here, these double zigzags. They last forever. Like I think Baba had been in like a double zigzag. And it's just like people are like, up, one zigzag down, like great, we're all good now, right? And then it's like corrective up and then just gets rejected. And then it's like, up, more downside. And it just like Baba correction has lasted a long time. Now, I will say that Baba had a lot of like fundamental problems of like the government and, you know, some sketchy things that the owner did, you know, there's the whole Chinese, you know, not to throw shade at China, but like technically you're not allowed as it, like a lot of people don't know this. This is a U.S. investor. Any stock that you own of a Chinese company, you don't own it. The government of China has made a rule that citizens of other countries cannot own stocks of their own companies. So what happens is that all these like Chinese stocks, you should read an article on this if you're interested in it, but like it's basically just you're kind of just following an index of that stock. It's really, you don't own any shares of the company like you do in American stocks. You really just are kind of owning this, it's like betting. It's like betting on a horse at a race. Like you don't own the horse, that you're betting on. You're just agreed to like pay a price based on how the horse moves. But if a giant cataclysmic situation happens in which like the owner of Baba really messed up, I think it was Yahoo who owned a ton of quote unquote Baba shares, but like because they're not like the owners of Yahoo, it's not like a Chinese company, like Baba owner was able to just say, hey, you're out of luck, sorry, you know, you get nothing, and they couldn't do anything. So like all that was to say is that be careful about charting on stocks that have like this, you know, that have unusual things happening. Like things can happen that just like don't follow the general patterns. So I stay away. I've heard this from other experienced analysts, and I agree too. So like stay away from things that have weird fundamentals going on. Double zigzag. These are painful, hard. Be aware that they can happen. You know, you think that you're starting an impulse up, and then it, like if you start to see something that's like it's looking more just like an ABC, and it's really not that strong right here. Like this is the point. If it was a third wave, this should be the strongest point. Why is it getting rejected here? Why is it like what's going on? Like be careful. It's talking about forming multiple theories here. So corrects down, you're like, hey, impulse up time. Well, just be aware that this can happen. Triangles. Triangles, you're moving up, and then you know, third wave finishes, and then triangle, remember, second to last wave in the sequence. A, B, C, A, B, C, A, B, C, A, B, C. So they're like 3, 3, 3, 3, 3. And they follow great Fibonacci relationships too. I think it's about a 618, if I'm correct. Let me look at the I have a cheat sheet here, but yeah, I think triangles follow, yeah, about 618 typically. Yep, about between 618 and 0.786 Fibonacci relationships to the prior one. So about 61%, 62% of this gets about 62% of this, 60%. So this one will get to about 62 of that, and continues. That's how it's so symmetrical. One thing that we're not going to cover 100%, we're not going to cover at all really today is leading and ending diagonals. Just be aware that that's something else to study. I don't think we're going to have time today to cover that. Maybe I can draw it out really quickly if I get some more time. Or if I finish these flats, oh my gosh, this is something that's like, yeah, just this is, you know, an introduction to flats. Flats are frustrating, annoying. They really mess you up. Flat, so we're going up, correction time, ABC down, okay, maybe it's over, going up, hey, maybe we're in the third wave, what? We're starting to not go above, like, but what are you talking about? Like, okay, we either double top here, for a regular flat, it's a double top down. An expanded flat really messes people up because, and this literally happened in the crypto market, where we saw a correction down in the crypto market. We reached new all-time highs. Everybody and their mom is buying Bitcoin. Like 69K it got to. This was like 64K for Bitcoin, 69K, and then it just goes down. And not only does it go down to like the bottom of where 30K, it went all the way down to 19K. We got an expanded flat in the crypto market. I can't say for certain because it's not 100% finished yet. It looks like that might have been what happened, but like, man, that is just the worst for people. It's just so hard, so frustrating to trade, but that can happen. I'd say they're kind of rare. They're not like, you know, they're not always typical. There's also the thing called the guideline of alternation, which is another kind of like pseudo rule, which is the idea that if you get for the corrective wave, you know, for the we talked about, like, you know, within the sequence, you have 2 corrective waves and an impulse wave up. And then if this is, so if you have a flat for your second wave, you're probably not going to have a flat for your fourth wave. It's probably going to be something different, an alternation. It might be a triangle, might be a double zigzag. And it tends to be that one of them is more bearish than the other. So if you get a really bearish second wave, then you probably won't get such a bearish fourth wave. Or if you get a really weak second wave, you might get a lot more of a correction on the fourth wave. It's kind of like almost like a mean reversion kind of thing. Like it kind of balances out in the end. So yeah, and then there's the running flat. The running flat is where it goes above, but then it doesn't dip below the lower low. It forms a higher low. So higher, so low, higher high, higher low, and then takes off. But like we said, in a bullish market to a bearish market, they may look a little different. Oh, sorry, I misinterpreted what I had here. It is not comparing the same situation. This is more just inverting them. So this is what it could look like in a bearish market where you're moving down, bullish correction, downside continuation, the side, downside, side. There are other charts that I have where it compares like how these flats might look if it's particularly bearish in a bearish market, that kind of stuff, but that's not the slide. So, okay, all right. Wow, I can't believe I covered all that material in an hour and a half. I was really worried that I wouldn't be able to. Channeling technique, and as well as Fibonacci's, as well as corrective price action. This is all just an introduction to this. This is just really kind of like boiled down, a little easier to follow than maybe reading a book right off of the bat. I really hope this kind of gave you guys a roadmap to Elliott wave that maybe saves you some time, maybe piques your interest, maybe gets you thinking, hey, like I want to study this more. Some next steps, I would say read the book. Read the book that was written on Elliott wave. Just Google like Elliott wave book and you'll find a lot of results for like the original writings of Elliott wave. And actually there's a lot of like modern rewritings, because that happened a good long time ago, to like kind of take a lot of modern price action into account and write out some sort of pseudo rules like the guideline of alternation. I'm not sure that was something that Elliott actually wrote himself, or if that was something that was just more observed by a lot of practitioners. But yeah, yep, yeah, that's one of the most popular ones, I believe. The Elliott wave principle, key to market behavior. Look that up really quickly, make sure that that is the one. But there's so many of them. I think Robert Rector wrote a good book. Jeffrey Kennedy also wrote a really good book. I really like Jeffrey Kennedy as an analyst in Elliott wave. Like I said, these things I've kind of gone through large periods of time where I've primarily used the technique, and then I start to just adapt it to my general trading approach. And that's kind of how I've done with Elliott wave. I'm not like a purist Elliott wave trader where I only oh yeah, this is the Frost and Prechter book. Yeah, this is a good one. Yeah, so this is a great one to start on. And so yeah, I'm not a purist per se in Elliott wave, where it's the only thing I do. It takes a lot of work, you know, looking at the price action and analyzing it. You know, there's a lot of other things that I use to scan for stocks and stuff, but you can you can write scans and things to kind of take into account some of these principles as well. You know, as you become advanced in writing codes and scanning things, you could look for say, like, let's say you're like, okay, I want to find some impulse waves that have finished their, you know, 618 of the last fourth, 618 of this particular part of the price action movement. You could write a scan that would do that. It would find you a list of stocks that may be finishing their corrective fourth wave, and you could jump in on that fifth wave. Things like that. It's, you know, you're gonna have to nuance them, and it's, you know, but yeah, there's so much you can do. And so I hope these two lessons on Elliott Wave have been really helpful, have piqued your interest, and feel free to reach out to us. Myself and Frank have spent years just studying Elliott Wave and trading, and so yeah, we can definitely be helpful. So feel free to reach out, and yeah, thanks for joining today, guys, and feel free to write any questions you have in the chat, but I'm going to close out the recording now.